So this combination of influences on demand, supply, and the exchange rate could lead to a materially lower path for growth and a notably higher path for inflation.
Hey guys, welcome back to a brand new video on our channel. Today we will be talking about the impact inflation has on the value of money. So what is inflation? If you didn't know already, inflation is an economic term describing the sustained increase in prices of goods and services within a period. To some, inflation signifies a struggling economy, whereas others see it as a sign of a prospering economy. Here, we examine some of the residual effects of inflation. The first effect of inflation is really just a different way of stating what it is. Inflation is a decrease in the purchasing power of currency due to a rise in prices across the economy. Within living memory, the average price of a cup of coffee was a dime. Today, the price is closer to $3. Such a price change could conceivably have resulted from a surge in the popularity of coffee, or price pooling by a cartel of coffee producers, or years of devastating drought, flooding, conflict in a key coffee-growing region. In those scenarios, the price of coffee products would rise, but the rest of the economy would carry on largely unaffected. That example would not qualify as inflation, since only the most caffeine-addled consumers would experience significant depreciation in their overall purchasing power. Inflation requires prices to rise across a basket of goods and services, such as the one that comprises the most common measure of price changes, the Consumer Price Index, CPI. When the prices of goods that are non-discretionary and impossible to substitute, food and fuel, rise, they can affect inflation all by themselves. For this reason, economists often strip out food and fuel to look at core inflation, a less volatile measure of price changes. A predictable response to declining purchasing power is to buy now rather than later. Cash will only lose value, so it is better to get your shopping out of the way and stock up on things that probably won't lose value. For consumers, that means filling up gas tanks, stuffing the freezer, buying shoes in the next size up for the kids, and so on. For businesses, it means making capital investments that, under different circumstances, might be put off until later. Many investors buy gold and other precious metals when inflation takes hold, but these assets' volatility can cancel out the benefits of their insulation from price rises, especially in the short term. Over the long term, equities have been among the best hedges against inflation. At close on December 12, 1980, a share of Apple Inc. cost $29 in current, not inflation-adjusted dollars. According to Yahoo Finance, that share would be worth $7,035.01 at close on February 13, 2018, after adjusting for dividends and stock splits. The Bureau of Labor Statistics, BLS, CPI calculator gives that figure as $2,438.33 in 1980 dollars, implying a real inflation-adjusted gain of 8,346%. Say you had buried that $29 in the backyard instead. The nominal value wouldn't have changed when you dug it up, but the purchasing power would have fallen to $10.10 in 1980 terms. That's about a 65% depreciation. Of course, not every stock would have performed as well as Apple. You'd have been better off burying your cash in 1980 than buying and holding a share of Houston Natural Gas, which would merge to become Enron. Unfortunately, the urge to spend and invest in the face of inflation tends to boost inflation in turn, creating a potentially catastrophic feedback loop. As people and businesses spend more quickly in an effort to reduce the time they hold their depreciating currency, the economy finds itself awash in cash no one particularly wants. In other words, the supply of money outstrips the demand, and the price of money, the purchasing power of currency, falls at an ever faster rate. When things get really bad, a sensible tendency to keep business and household supplies stocked rather than sitting on cash devolves into hoarding, leading to empty grocery store shelves. People become desperate to offload currency so that every payday turns into a frenzy of spending on just about anything, so long as it's not ever more worthless money. The result is hyperinflation, which has seen Germans papering their walls with the Weimar Republic's worthless marks, the 1920s. Peruvian cafes raising their prices multiple times a day, the 1980s, Zimbabwean consumers hauling around wheelbarrow loads of million and billion Zim dollar notes, the 2000s, and Venezuelan thieves refusing even to steal bolivars, 2010s. As these examples of hyperinflation show, states have a powerful incentive to keep price rises in check. For the past century in the US, the approach has been to manage inflation using monetary policy. To do so, the Federal Reserve, the U.S. central bank, relies on the relationship between inflation and interest rates. If interest rates are low, companies and individuals can borrow cheaply to start a business, earn a degree, hire new workers, or buy a shiny new boat. In other words, low rates encourage spending and investing, which generally stokes inflation in turn. By raising interest rates, central banks can put a damper on these rampaging animal spirits. Suddenly, the monthly payments on that boat or that corporate bond issue seem a bit high. Better to put some money in the bank where it can earn interest. When there is not so much cash sloshing around, money becomes more scarce. That scarcity increases its value, although as a rule, central banks don't want money literally to become more valuable. They fear outright deflation nearly as much as they do hyperinflation. Rather, they tug on interest rates in either direction in order to maintain inflation close to a target rate, generally 2% in developed economies and 3 to 4% in emerging ones. Another way of looking at central banks' role in controlling inflation is through the money supply. If the amount of money is growing faster than the economy, the money will be worthless and inflation will ensue. That's what's happened when Weimar Germany fired up the printing presses to pay its World War I reparations, and when Aztec and Inca bullion flooded Habsburg Spain in the 16th century. When central banks want to raise rates, they generally cannot do so by simple fiat. Rather, they sell government securities and remove the proceeds from the money supply. As the money supply decreases, so does the rate of inflation. When there is no central bank, or when central bankers are beholden to elected politicians, inflation will generally lower borrowing costs. Politicians' occasionally detrimental fondness for inflation has convinced several countries that fiscal and monetary policymaking should be carried out by independent central banks. While the Fed has a statutory mandate to seek maximum employment and steady prices, it does not need a congressional or presidential go-ahead to make its rate-setting decisions. That does not mean the Fed has always had a totally free hand in policymaking, however. Former Minneapolis Fed President Narayana Koker-Lakota wrote in 2016 that the Fed's independence is a post-1979 development that rests largely on the restraint of the president. Demand can rise because consumers have more money to spend. More spending increases inflation, in particular, higher consumer confidence. When wages are steady or rising and unemployment is relatively low, inflation is likely to rise. As well, manufacturers are likely to raise prices if consumers are willing or capable of spending more. Anyways, that is it for this video. Thank you so much for watching. Don't forget to smash that like button and subscribe to the channel with notifications turned on so you never miss an upload. Goodbye.